Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending April 28th, 2023. I'm Preston Brenton. Thanks for tuning in. Well, the theme this week, as you can see, is what next Fed? And of course, we get the Feds coming up next Wednesday. We'll get an idea what they're going to do. But first, let's just kind of take a look at where we've been this past week and, how things are starting to set up here as we move more than halfway through Q1 earnings. As you can see on the screen as it comes up, everybody kind of a mixed market, but Dow, S&P, NASDAQ up in the green, year to date in the green. Russell only one in the red, barely hanging on year to date. Attention kind of focused really on earnings. I said Thursday we got gains in four stocks, Microsoft, and a few others that really have moved the markets. But one thing you need to understand, the breadth in the market is getting very, very thin. Just four stocks, Microsoft, Apple, Amazon, and Facebook, or Meta, account for almost half of the S&P earnings so far this year. Really, that's the largest dichotomy or divergence we've had in breadth since the early 1990s. Okay, Meta also, they came out with earnings and jumped up over 14% in their cost-cutting measures. In this past week, we did see cyclicals performing very poorly, as a lot of money is weighing signs of an economic slowdown. Particularly in the manufacturing sector. Also, early in the week, we got several measures of regional manufacturing activity also came in below expectations as well. Okay, and we did see that shipping volumes in UPS fall over 10%. So we are seeing a slowdown in the economy. But like I said, we've had the narrowest stock leadership since 1990s. And there are really six companies. And in addition to Microsoft, Google, Amazon, and Meta, I'm going to throw in NVIDIA and CRM. But they are driving almost over 50% of the gains this year, just in these six stocks. Really amazing. And we've got just a lot of activity going on in the market. Now, a lot of people believe that the market low has already been made last October, but just one interesting stat I think worth knowing is that no bear market has ended without a big move in volatility or before the recession has begun, troughing before the recession has begun. So we'll see how all of that stuff shakes out. You can see over here on the upper right-hand side, the forward PE is at 18.87. I still think that's too rich. Given the slowing down in the economy, I think that's going to be adjusted lower as we move through the summer. I also have a sell in May and go away kind of warning for a lot of investors. Be very careful over the next 90 days. You can see the 10-year treasuries at 3.44. It's off of the 4% level we saw earlier in the year. Dividend yields at 1.68%. Earnings yield is 5.38. So the yield of the S&P over the 10-year treasury is 194 bips. You can also see the real yield is now finally in the green with inflation at 5%. But I think inflation is going to be rather sticky for a while. One other metric that I want to point out here is the current VIX closed the week at 15.72. The markets really haven't gone anywhere for a while. That's why the VIX is so low. The prior week it closed at 16.58. So that's the first print we've seen in the 15 level or closing print in a long, long time. So the volatility was down about 5.19% for the week. Also, you can see the best sector for the week, communication services, also the best sector year to date, 25% up. Worst for the week is utilities. Financials obviously bringing up the rear year to date. Okay. We did see GDP come in at 1.1% this Thursday, well below consensus expectations. And then Friday, we saw the PCE, the personal consumption expenditures. They take out food and energy. It's one of the Fed's preferred inflation gauges. It rose 30 basis points in March for a second month. The measure is up 4.6%. So it's over double where the Feds want to see this. So that's why I think there's about an 85% chance the Fed's going to hike the rates, 25 bips. That would be the 10th rate hike coming up since they've been hiking the rates for over about 9 months or so since last summer. And then obviously as the markets close this Friday, we see that unless another bank steps forward, the government's going to probably step in, or the FDIC is going to come in and take over a receivership with First Republic. So is that going to offset the markets early next week and a little bit of a pullback? I think the odds probably favor that a little bit. Okay. And then, of course, if we go across the pond and take a look at the Euro stocks, FTSE, CAC 40, DAX, all of them, most of them were in the red for this past week, not by a lot. DAX was the only one in the green. Year to date, well into the green. But the Eurozone economy is also treading water in Q1 as well. Their GDP ticked up to 10 basis points. And that was a step up from the final quarter of last year when GDP was about flat, but it wasn't negative. But Europe's going nowhere fast, okay? And in fact, economists polled by FactSet predicted growth of 15 bips for the quarter. So they're slightly below even what the economists were thinking. The sentiment in the Eurozone also is kind of steady. Consumers and retail service sectors are remaining a little bit resilient right now all across Europe, but manufacturers are still pessimistic about their production and new orders. And meanwhile, over in the UK, their budget deficit grew to 139 billion pounds in the year up to March. That's more than 18 billion year over year from last year. That's the highest on record for Great Britain. So we'll see how that plays itself out. Meanwhile, in the Asian markets, you can see Bank of Japan. They had their first meeting with their new governor, Kezao Ueda, on April 27th, 28th. And they signaled policy continuity. All right. So the central banks kept their short-term policy interest rates at a negative 10 basis points. And they also left unchanged their yield curve control framework, their YCC. So we're going to see how that plays itself out, although they did upgrade their forecast for their inflation to 1.8% this year. All right. And then they're going to up to 2% in next year. So they are seeing inflation moving up. I do believe they're going to come in and start to alter their yield curve control, which is why, as I was working with our members last Sunday on being long the Japanese yen, as we are the euro. Okay. And then, of course, in China, you can see they were in the green. Hang Seng Hong Kong Index was in the red, but both in the green year to date. We saw profits in industrial firms in China fall a lot in Q1 of this year to Q1 of last year. And they're still trying to get out of their zero COVID policy. They're kind of struggling from that. They were in this pandemic induced slump a lot longer than most others. So we'll see how all of that shakes out. But anyway, very interesting markets that we got afoot right now. I'm going to shift you over and just show you a couple of quick charts that I'm looking at here in the market. So let me just shift the screen here. And let's move you over to right here. We're going to take a look at the E-mini S&P 500 futures. And what you're going to see here is we finally took out the 0.236 fib node. All of this movement here, FYI, above this fib node happened after the markets closed, okay? It just came right up. I suspect we're going to move back below again. You can see we got a little bit of a bearish divergence in this MACD here, and we're near the highs for the year that were made on February 2nd, right, for 2023 at 42.08. But this is huge resistance for the markets, all right? Huge resistance. And I suspect the odds favor a rollover instead of moving back up. But we will see. It depends right now on where the Feds go. And again, like I said, after the markets closed, we got that news on First Republic Bank. The Feds are trying to find another bank to buy them. If they don't, then the FDIC is going to step in and take over in a receivership. So they're going to need to get that solved over the weekend, which I think they will. And we'll see how all of that stuff plays out. Okay. Remember what I had said, and I told you guys a couple of weeks ago on our members. I said we're probably going to pull back to this zone right in here from 40.82 to 40.53, and then we'll probably run up here, and then that'll be it for a while. And if I were to mark it and then just kind of see. This would be a short-term target, I would see, and then we're probably going to be pulling back here. So I don't see too much more upside. I see a higher risk of downside move in the markets here. And if we come back over here and we look at the Fang Index, and these were not all, these are just some of the ones that I'm tracking. You can see here that in this custom index I have here, it's Microsoft, Meta, Apple, Google, and Amazon. I do believe this is going to pull back here and come back and close that gap right in this area here. So I think that's going to be probably a no-brainer for the Fangs. They've had a huge run, and if you can see with the Fangs, they're up. Their high point was made right here on April 27th, up 41.66%. Okay, now let me just step it out for you guys for a second. Let me just show you something here. You got to look at it in terms of where we've come from. This is the Fang Index going back to last January. So you could see that big, huge move lower. We just really got crashed. And now we're having this reflective bounce right here that really kicked off in the beginning of this year, right? I mean, we almost double tested this low here, and then we had a great move up. But I think we're getting into this zone right here. And let me just highlight it here like that, right? So that zone right there, where I think we're gonna, whoops, I didn't mean to do that. So you're gonna see here in this zone where it's gonna run into a lot of difficulty, come back and probably backfill a little bit. That to me would make a lot of sense, all right? And because it's basically over 53% of the profits so far in the markets, then to me, it makes sense that a little bit of a pullback is going to be in order. All right. And if I add the volume up of all these, you can see, though, that that was on very strong volume. So the pullbacks are still going to be light, right? Mainly because these FANG stocks are acting more like strong growth stocks instead of high risk growth stocks with strong balance sheets, a lot of cash. So I think a little bit of a pullback would be in order, and then a bottoming here before it makes another run up. Okay, and if we look at the SPX equal weight index, right? This is assuming every stock in the index accounts for only 1/500% of weighted value. Right now, just as a reminder, Apple and Microsoft are like 13 or 14% of the entire weighting of the S&P. But assume every one of them has an equal percentage weighting. You can see we were actually in the red on the equal weighting on the 26th, this past week, in the red for the year, guys. And then on the 27th, we moved up just barely off a flat line, okay? And then if I just look at the SPX, weighted, a cap weighted SPX, I mean, look at it. We're near the high set, as I said earlier, right here, right? So the breadth, as I indicated earlier, hasn't been this thin since the early 90s. So if these stocks start to pull back and others don't pick up, which I think is a higher probability, we're going to have a little bit of a downside. Now, a lot obviously is going to depend on where the Feds come in on Wednesday with their policy statement and press conference. So there's going to be some issues there. And then Friday, we get the key jobs data, unemployment data for the entire month of April. So these things are going to be very important, and they're going to be drivers. I think the odds do favor a pullback, though. All right, that's what I see. Maybe a little bit of a run higher, but you can see just that pullback is probably going to be something that would be a higher probability move. The risk to the downside is much greater than the risk to the upside right now. Okay. And of course, if we come down here and look at the VIX is closed very low. Right now, let's put it on a weekly chart just to give you guys an idea. And this is volatility. You can see here that it hadn't been this low really since October of 2021. Very, very low. Now, I don't think it's going to stay down here because we haven't been in the green really below 15, 14 since 2020, before COVID. After COVID hit, the markets have been jostled, going back between yellow and the yellow zone and the red zone, right? And I just use these for just general calibration purposes. But you can see here this low point right here. So it's still in a choppy market because this zone tends to be very choppy in the equities when the VIX is still here. But generally what we get when the VIX is down at this level is another pop back up. We attempted it about a week and a half ago, but then we pull right back down again. That was that point that I said we're going to experience a little bit of a pullback, and then we should make another higher point, which is what we're in the process of doing right now. But like I said, we did get that First Republic Bank issue after markets closed on Friday, so we may get an initial sell-off and then a bounce back. Hard to tell right now because we do have the FOMC and the Fed policy statement coming right up. If we look at the bond market, you can see it was up strong on Friday, driving interest rates lower. Okay, the higher the bonds go, the lower the interest rates go, and there's still that bifurcation, as I keep telling our members, between the bond market and the equity market. The bond market normally wins. The bond market is saying the Feds are going to be forced to cut rates the end of the year. The Feds are saying they're not going to cut rates the end of the year. If they don't cut rates through the end of the year, then you're going to see valuations come down. But the reason why the bond market is saying they're going to be forced to cut rates is we're going to enter into a recession. Now, the debate is whether it's going to be a soft recession, just a tiny slight recession, or a hard one. And that is going to be a hard call right now. There's another big black swan hanging out in the markets right now, and that is the X date for the budget deficit and the budget for the U.S. And that's coming up in July and August timeframe. The last time we had a big move, and that was back years ago when the markets fell over 8%, when and the S&P downgraded the U.S. Treasuries by a half a tick. And the markets moved down 8%. So we've got that on the horizon as well, also in the summer. So I think this big move up here, folks should use it as an opportunity to adjust their portfolios and just be ready for some craziness over the next 90 months, 90 days rather, sorry. And then of course, if we look at the interest rates, we'll look at the 10-year interest rate right here. You can see in the 10-year interest rate, it's staying well below the 50 EMA and the 200 EMA. So the rates are making the bet that the Feds are going to do one rate hike this Wednesday. It's, like I said, about an 84% chance. And then they're going to be one and done. And they're going to sit back, and that'll be the last rate hike they do in this cycle. And then they're going to start being forced to cut rates in Q4 of this year. We'll see how that works. But that's what the bond market is saying right now. Okay. And the bond market really drives the equity market, not the other way around. If we look at currencies and we look at the dollar, it's holding on over that 100 level, right? I think the dollar is still destined to go lower this year. My target is down below 99, 99.5, which means the euro is going to be stronger. But right now, we're just consolidating at this level, okay? And of course, if we look at the euro, you're going to see the euro is just the opposite. My target for the euro is up over 111.6, up in this area here. We've come very close to my target already, but I think it's going to come up through this area and then consolidate more before it decides where it wants to go. We've been long the euro in and out several times this year, and it's been a great trade for us. The yen is the other new one that I do believe it's going to go higher, but be careful. They filled this gap right here, and the reason why it fell down through that gap is when the Bank of Japan met, they're going to leave all their policies the same. I think they're going to be forced to change their yield curve control mechanism, the YCC, and that's going to push the yen up. You could see that's what the markets were expecting. They didn't get it. It's probably going to come down and settle them somewhere down here, and we'll be able to get in for a good entry. I said the most likely event was to come down and fill this gap, and it did that. And then obviously when the bank came out with their statement, that really pushed the yen down. But I do believe the end of the year it's going to finish well north of where we are right now. Okay. Then of course, if we look at some of the commodities, if we look at gold, I think near term for gold, as I've been telling my members, is more to the downside, and then we're going to come back up again. All right. So I had suggested to some of our members that we should be selling gold up at this area up here. A little bit of a pullback. I don't think it's going to pull back more than 1950, but certainly to the 1960 50 EMA level, and then I think the upside it'd be a better bet for an upside here. We have ways to trade gold rather than taking a directional bet that makes a lot of sense, and we're making money on it. Much like the same way we're doing oil. If we take a look at oil here, you can see it's still in the red for the year. It filled that gap as I said it would. It moved all the way up here, but that gap was just too easy to to miss. So it came down here, and I had said set up some trades that we can make money as it comes right into the meat of our trade, which is what it did. And we had a number of members that took that trade and made some really nice money on it. I do believe it's going to probably make another attempted run to take this out and may get there, right? If I mark it, let my system do the calculation rather than put it in. It's showing that oil can move back up to the mid 80s, and I do believe that is a doable number. So playing long oil here, neutral to long bias, I like that in the oil markets. All right, everybody, that was a really quick session for this weekend. Members, I will see you Sunday evening. We'll spend more time on the markets and the Feds and interest rates and some opportunities here in the market. Otherwise, have a really great weekend, everybody. Members, I'll see you Sunday evening. Take care, folks. Ciao now.